All right, super cool. Well, so financial freedom webinar. So this is what we are here for today. Let me start with the very first thing, that is the agenda, the takeaway from this webinar. So what you will get today is how to build wealth in stocks without worrying about risk. Right now, this is something which will be very clear to you by the end of this session, that what is the process, what is a way to build wealth without worrying about risk. Right now, there's a gift, small gift for all those who will stay till the end, who will devote their time and attention. At the end of the session, I'll share this ebook with you. It's a document of curated videos and articles. So basically, as a part of my own learning, I watch a lot of videos and read a lot of articles. Whenever I find something really valuable, I keep a note of that. I keep jotting it down. So I have compiled around 22 such videos and 12 such articles, which are excellent in terms of investment insights. So I'll share this with you, and this is password protected. So only those who stay till the end will get the password, and Deepak will share this document in the email. So you can access it with the password. All right. So why are you here? So this session is for you if you have never invested before. So if you're totally new to stock market, this session is for you. It is also for you if you have invested before, but you have lost money, you have burnt your hands. All right. And if you are afraid of losing money in stocks, so whether you have invested before or not invested before, if you are afraid of losing money in stocks, then this session is for you. Now, before I proceed, let's find out from the people who are on this call, on this session. Deepak, I guess I need to access the polls. You need to make me the host for that.
Yeah.
Deepak, are you there? Yeah, right. So I'm launching a poll which says, do you invest in stock market currently? Just answer yes or no. So do you invest in stock market currently? Let me see. I want to know my audience. Let me see how many people here are current investors or how many people are enthusiastic about investing in stocks. When I say do you invest currently, means if you are currently invested, that is if you have invested in the past and right now you don't have any stocks, right? No. All right, so I can see more than 60% so far are not invested. A few more seconds, those who have not answered can answer. All right, 5 seconds more and I'll end the poll. So still more than 60% people in the group right now are first timers who might start investing after this session. All right. The poll results is around 62% people out of 674 who have voted have not invested in stock market or not currently invested in stock market. All right, interesting. So this session, as I told you, is for 3 kinds of people: never invested before, if you have lost money in the past, or if you are afraid of losing money. All right. Now, why should you invest your time with me? Just a brief about myself, though Deepak already introduced me. So I'm a SEBI registered research analyst. There's a license which we get from SEBI to recommend stocks in the Indian market. I'm a certified financial planner as well. I started my investments in 2006, but my this is more hereditary for me because my father started in 1978, and so that's combined. My experience and his experience combined is more than 56 years of experience now, and this is what you will get today in the webinar. You will pick up tools basically which has helped our family to become financially free. That's exactly what you will get today. And having said that, financially free, it has not come easy to us. When my father started, as he tells me, and as we know, there were no books, there was no internet, and no one knew Warren Buffett, right? So 1978, most of the 80s, even till the early 90s, all this was not very common, right? Investing in stocks and having access to a lot of information, that was not very common. I was fortunate enough, I got to read a lot of books, annual reports and research reports which are readily available in the market now. It has took us decades to develop a filtering process to shortlist the stocks which can yield great returns in the long term. Are you now? I'm going to share all of this free of cost with you, the entire filtering process. Are you excited to learn all this quickly in next 60 to 90 minutes? If you're excited, type excited in the chat box. Are you excited to learn all this in the next 60 to 90 minutes? The entire filtering process which we have. All right, cool, great. So let's start with the 3 secrets of stock investing. Something which most of you would not have heard of. All the 3 things which I'm going to share. Number 1, only wealthy people understand inflation. Now, some of you might say, what do you mean by that? I mean, inflation is a very simple concept. I know what inflation is. Some of you might be from commerce background or economics background. By the way, I'm an engineer. I'm not from this background, but let me tell you very clearly, you will be blown away when you get the actual concept of inflation in the next few slides. By the way, how many of you are engineers here? Type I in the chat box if you're an engineer. All right, Sumit is there. Okay, quite a few. Very happy to. Or there's a dropout as well. Interesting. All right. So I'm an engineer by qualification turned investor, and I moved to the finance field. So that's how the journey was. So that's the secret number 1. Number 2, how many of you have heard higher the risk, higher the return? That's a very common phrase. People say it for business. I mean, if you want to earn in business, take higher risk. People say it in investments. If you want to take make higher returns, take high risk, right? So I am saying lower the risk, higher the return when it comes to stock market, and I'll prove it to you in this session. Don't worry about that. You'll get it very straight in this session. It is actually lower the risk, higher the return. Higher the risk is equal to higher the loss. As simple as that. Let me share that details with you in the next few slides. And the third secret, stock market is the easiest way to get rich. Now, a lot of you who might have invested in the past, or you would have seen your friends, family, colleagues, your extended family, neighbors investing in the market. Most of the people you talk to, they have lost money in the stock market. Despite the fact it is the easiest way to get rich. And you will also get to know this secret in this session. All right. So these are the three secrets we are going to talk about. Let's start with the first one, that is inflation. Now, inflation of your household. As per the government of India's figure, in last 40 years, from 1980 to 2020, inflation in India on an average is 7.5%. So every year your expenses were increasing by 7.5% in last 40 years average. Now, why I'm talking about 40 years? Because 40 years is lifetime of one generation. You start working at 22, 25, working life of one generation. You start working at 22, 25, you work till 60, 65 and you retire. In these 40 years, you see good and bad times, both in terms of returns, in terms of inflation, in terms of interest rates, right? So when we take 40 years, you get a very unbiased and an average figure. Rather than taking last 5 or 10 years, inflation might be very low, but last 40 years is what your family has created wealth. In these 40 years, one family or one generation creates its own wealth. In those 40 years, inflation has been 7.5%. But what I am saying is, inflation of your household and my household is much more than 7.5% because of something called lifestyle inflation. Let me give you some examples. Okay, all right, let me give you an example, then we'll do one more poll. Talk about mobile. 20 years back, it was hardly there. I mean, people just started buying mobiles 20 years back. Today, it's a necessity. Every family member has got it. Everyone changes it every 2-3 years, and you pay the bills every month. So it's something which came as a luxury has become now a lifestyle, right? Let me give you one more example. Traveling in flights. I remember in 90s, it used to be an event for me to even go to an airport to pick up some relative who is coming, right? I mean, we were not that well off in 90s, at least, that we could travel in flights very readily. Today, I mean, go to an airport, it's like a new railway station. I mean, not in this COVID situation, but yeah, in general, if you go to an airport, you have seen the kind of crowd you see there, right? It's almost like a railway station or a bus stand. So that's called lifestyle, which people have changed over the last few years. Talk about simple things. Talk about going out for a dinner. I remember in 90s, going out for a dinner used to be an event. You know, that parents are taking us out for a dinner today. Today we eat like 5 times a week outside. I mean, maybe we order from Swiggy or Zomato if we don't go out, but we eat out, right? Again, don't talk about the current situation. We know this, it's very different, but yeah, in general, I'm talking about, and we'll get back to those normal times is what I believe. Last example, buying an AC for the home, or a TV for the home. I remember the first AC which came, it was again an event for us. But now we have number of ACs equal to number of the rooms in the house, including the living room, right? Number of TVs is equal to number of rooms in the house, almost equal to that. Even the number of four-wheelers in the house is equal to the number of adult family members. right? All this is called lifestyle inflation. Now, my question to you is, let's figure out what is your family's inflation in last 40 years. What have you witnessed? So in 1980, 40 years back, how much do you think was the household expense of your family? A lot of you would not be born in 1980, even I was not. But when you talk to your parents, your grandparents, they tell you, this was the kind of salary we had, this is the kind of expenses we had. So even if you know the kind of salary they had in 1980, you would know what was the expense out of that. So I'm talking about 1980, not 1990, right? So let me see if we can do a small poll on this. All right, I'm launching a poll. Just answer what is true. And for a family of 4, by the way, if you were a family of 10, reduce it accordingly for a family of 4 and answer that. In 1980, for a family of 4, how much do you think were the expenses per month? This is per month expenses. 1980 in India, not 1990. 1980 is very, very far off. Just think accordingly. What do you think was the expense of your family in 1980, assuming you were 4 family members? Usually we had bigger families that time, so you reduce it proportionately for that. If it was 6 members, reduce it by 1/3. If it was 8 members, reduce it by half. All right, so most of the people are saying below 500, and 500 to 800, then 800 to 1200 is 16%. All right. A few people say it was above 1200 rupees. Okay, depends on which city you were in, of course. If you were in a metro, it could be more than 1200 as well. All right, next few seconds, 5 to 7 seconds, I'll end the poll. Anyone else who wants to take a vote on this? Family of 4, 1980. All right. Okay, so the result says 44% people in the out of 712 people are saying below 500. So basically 92% people are saying below 1200, and 8% people say it was more than 1200 for them. All right, got it. Now, let me tell you, this is 1980. So let's look at 40 years forward. That is 2020 today, right? What are the expenses of your household today? And when you look at the expenses, you must look at all the 4 things. Some expenses are monthly, some expenses are quarterly, let's say children's fees. Some expenses are occasional, for example, shopping, for example, going for a vacation. Some expenses are yearly, right? So you combine all the expenses you do in a year and then divide by 12 to come at a more realistic figure. Because some months you might spend less, some months you might spend more. So think about your children's education. Let's say you're a family of 4 and both the children are in school between say 5 to 15 years of age. Think about the education cost. Think about the number of vacations you do in a year, the international vacations, the domestic vacations. Think about the shopping you do. Think about the furniture you get once in a while. Think about the compliance, the electronic appliances which you get, the expensive mobile you will buy, the watch you will buy. Once in a while you get different kinds of things in the house, and you don't get to know how much you end up spending, right? So let me do a small poll in this as well. What are your expenses today, that is in 2020, for a family of 4? Please ensure you're talking about a family of 4. If you're only husband and wife, you're only 1 children, increase it accordingly. Per month expenses, I've launched the poll for a family of 4 in 2020, including all the expenses you do in a year, and divide by 12. All right, we're getting pretty interesting data. 50 to 75,000 for 50% of the people. Few people are above 1.5 lakhs as well. Well, so I'll share about myself. So I'm staying in Bangalore. I'm a family of 3. I have 1 daughter. We are spending around 1.5 already. So I believe it will go up if we go for the second child. But yeah, so that's the case right now, 1.5 lakhs. All right, few more seconds. So why are we doing this poll? So that we get to know the actual figures. I don't want just 7 or 8 replies in the chat box. I want most of the people to answer this so that we know where we stand. And we are calculating your own inflation. I am not going to tell you some random theoretical number. We are talking about the real inflation which your family has experienced in last 40 years. All right. Okay. Ending the poll. So we got more than 50%. So we had more than 50% people below 500 in the last poll in 1980. So we have more than 50% people from 50 to 75,000. All right. So can we say that the expenses have increased approximately 100 times in last 40 years? From say it was 500, it has become 50,000. If it was 1,000 rupees, it has become 1 lakh. If it was 1,500 rupees, it has become 1.5 lakhs. 100 times in last 40 years, right? Got it. Now, if you increase something by 10% per annum for 40 years, it becomes only 45 times. So if your expenses were, let's say 1,000 rupees then in 1980, and now it is 45,000 rupees, it means you have experienced 10% returns, inflation in last 40 years. For 100 times expenses increase, it is actually 12%. Let me show you some calculation. So if it was 10,000 rupees in 1980 and increased by 10% every year for 40 years, it becomes 45,000. At 12%, it becomes 93,000. That is almost 100 times or 93 times. And at 14%, it becomes almost 2 lakhs, 1.88 lakhs. Right? Now, think about it. This is the inflation which your family has suffered. This is the inflation which your family has to go through in last 40 years, irrespective of what government was quoting. Right? Now, if you are not making returns more than this, you're losing money. As simple as that. That's what the simple concept of inflation, which only wealthy people understand. If 10% is your bare minimum inflation, 45 times is minimum people have increased their expenses by in last 40 years. And if this is the inflation you have witnessed, 10%, you must be making at least 12% returns so that after paying taxes, you can get 10% in your hand. So actually 12% is the bare minimum return which you should have made in last 40 years to beat the inflation or to match the inflation, not even beat the inflation, right? So those people who have not made 12% returns in last 40 years are not wealthy today, as simple as that, right? Now, why am I talking about all this? Why aren't we going to the stock thing directly? I'm creating a foundation for if you don't know why to invest in stocks, you would move out of stock market very quickly. You will not learn from your experience. You will not learn from your mistakes. You will not learn when you lose money. You will panic and you will exit. That's what 99% people do, right? So it's very important to understand the concept why stock market. Why can't you do without it? If you know this concept very well, you will put in your hard work, you will put in your learning effort to get where you want to get. Right? That's why we're talking about this foundation of inflation and investments. So let's see, if I'm investing 5,000 rupees per month for next 40 years, which becomes 60,000 per year, and multiplied by 40, 24 lakhs per annum. For 40 years. This is a different rate of interest, saving banks 4%, insurance, by the way, insurance, gold, FD, bonds, PPF, RD has given between 7 to 9% returns in last 40 years average, which is below inflation, right? Inflation is 12%, as we said. I mean, 12% is what you need to earn so that you get at least 10% in hand. And stock market and real estate has given 15% and above. So if I end up investing 5,000 per month in a savings account, this is what you get. 24 lakhs becomes 0.58 crore, that is 58 lakhs. And the next three amount, look at this. 7% gives you 1.24 crores, 9% gives you 2.12 crores, and actually you wanted to make at least 4.989 crore, or let's say 5 crores. So only if someone has 5 crores today, let's say a retired couple, 65 years of age, they have done with all the liabilities, the children are married, they're settled, they have their own house. If they have 5 crore rupees in their bank account today in the FD, they know they will live their retirement life without any problem, without any looking for a job or looking for money from anyone, right? Now, look at the returns for next 4 things. 15% gives you 11 crores, 16% gives you 15 crores, 18% gives you 27, and 20% gives you 48 CR. Right? So all the people on the left-hand side of 12% are the people who were looking for guaranteed investment, guaranteed returns. Right? Look around you, you will find 2 kinds of people. One, those who are working at the age of 65, 70. 2, at the age of 65, 70, they are dependent on their children. And all these people ended up investing in insurance, gold, FD, bond, PPF, RD for their entire life. They could not make 12% returns, and that's how they could not beat the inflation, and they don't have enough money to survive for the next 20 years of their retirement. Right. Let's look at the same table. 20,000 rupees per month. Look at the last four figures at 15%, 16%, 46 CR, 61, 109, and 194. By the way, if you think these figures are too big to to achieve, or too big, too big for the requirement, just think about this. What do you think will be your yearly expenses in 2060? If it has become 100 times in last 40 years, will it become at least 50 times in next 100 years? Even if the inflation is not as high as 12%, or maybe 25 times in next 40 years? 25 times of 1 lakh is 25 lakhs per month. That is 3 crore rupees per annum. If that is your expenses, these 46, 61 crores are not big figures. This is something you need for financial freedom. That's why it's called magic of compounding. You don't get to see what will happen in the next 40 years because the figures become very big because of compounding. Right? Now, it sounds absurd, 25 lakh rupees per month or 50 lakh rupees per month of expenses. But if you said the same thing to your grandparents in 1980, that your family would be spending 1 lakh rupees per month in 2020, he would have said the same thing. Crazy. It's very tough to imagine that kind of a number. In 1980, it was very tough to imagine that kind of a number. But it's very common now, right? 50,000, 1 lakh, 1.5 lakhs per month of expenses. This will become common 40 years down the line. Right? So you need to beat the inflation. And the last example of this table, look at this, 50,000 rupees per month, which is 6 lakhs per annum. Not a big amount to invest if you think about it. 6 lakh rupees per annum, you get maybe a small piece of land in the outskirts of Bangalore. Look at the amount, 115 CR, 153, 273, 487. Now, one last question on this table. Why do you think I have not taken more than 20% example of more than 20%? Because even making 12 to 15% is more than enough. And let me ask you one more question. Any guesses on how much Warren Buffett has made in last 55, 60 years of his investment? He's, by the way, the third or fourth richest guy in the world. And he has created his entire wealth through stock market. He's worth around $85 billion today. And he has made money only through stock market. How much returns do you think he has made in last 40 years average? Let me see if we have a poll on this. I think we do. All right, we have a poll on this. So just take a guess how much returns he must have made every year on an average basis to become as rich as he is today. Is it below 25%? Is it 25 to 50%? Is it 50 to 100? Or is it more than 100% per annum? He's worth $85 billion. First, just note that. All right, we're getting pretty much equal responses so far. 25% each for all the four so far. Interesting. How much returns do you think Warren Buffett has made to become this rich in last 55 years on average? Is it above 100%? Is it 50 to 100, 25 to 50, or below 25? All right, I'll end the poll in next 5 seconds. All right, let's look at the results. So almost 25% each for all the four categories. Okay, interesting, very interesting. So I'll give you the answer. The answer is below 21%. So Warren Buffett has made around 20-21% returns compounded annually to become this rich. And that's the reason I have not taken an example of more than 20%. Because if you and I can make 15% returns per annum in the next 40 years, the next 30, 40 years of our lifetime, of whatever time we have, working life we have, that's more than enough. And it will be a challenging task to make 15% because you have to make 15% on the entire asset class which you have, average 15%. If you have 100 rupees of total investments, you put 90 rupees in FD, gold, RD, all these kind of stuff, and put only 10 rupees or 5 rupees or 1 rupee in stock market. And even if you make 30% returns in stock market, that's not sufficient. Because your average return on the entire 100 rupees of investment is not 15%. It's challenging. It's not easy. But the idea is don't aim for 30, 40, 50% kind of returns in stock market. It doesn't work. It doesn't work in the long term. It's not practically possible. When Warren Buffett could not do that, Philip Fisher, Peter Lynch could not do that. Why do we need to even try that? Why do we need that kind of returns? 15% is giving you 115 CR. Look at the returns. Right? So you have to be very clear about two things. Number one, how much return you need, that is more than inflation, and what is the highest level of return is which is more than enough. There should be more than 12%, up to 15% is more than enough. If it's more than 15%, that's a bonus, right? So you need to set your expectations right. Your friend is making 25% return in the stock market and you are making 15%, you feel you are losing out money. Don't do that. You don't know how the kind of risk your friend is taking. So don't get distracted by that. Focus on your investments, right? Now, all right, so we get to the next part, which is the stock market, which a lot of people were asking, like, let's get onto the stock market filtering process. So we are getting onto that. Just one question before that. Let me tell you one more fun fact. Less than 5% of India's population is investing in stock market and mutual funds combined today. Less than 5% of adult population of India. Someone is saying can't hear. Can you hear me properly? Right, yes, if you can hear me properly. I think my chat has. All right, great. So less than 5% of India's population is investing in stock market, which is 55% in US. And as per RBI data, those 5% people who invest, or 4 or 5% people who invest in stock market, so when I say stock market plus mutual funds combined, I'm including mutual funds as well. So those 4-5% people who invest in stock market in India, as per RBI data, they invest less than 1.5% of their total wealth. So if someone has, let's say, 1 crore of total wealth, including their own house, their properties, their let's say their gold, insurance, FDs, RDs, everything. So out of 100 rupees, 1.5 rupees is in stock market. So why do you think we have such a low penetration in India when it comes to stock market? Write your answer in the chat box. What is your reason maybe that you don't invest in stock market? As we saw, more than 60% people in this group right now are not risky. So Meenak is saying it's risky. That's a good reason. What else? Risk and knowledge. All right, less knowledge, fear of losing. All right, so that's risk, fear, right? So you don't invest because you are fearful. Volatility, fluctuation. Very good, Ramesh. It is risky. Not enough money, not enough money. So, but you do invest in other assets, right? I mean, as a family, if you look at, it's not that you don't invest anywhere. No guarantee of profits. All right, so you need some kind of assurance and security. Don't have proper knowledge. Got it. All right, got it. So the real reason for such low penetration, as per my experience and my observation, is risk. As some of you already mentioned, that fear and risk is the same thing. The risk of losing money is what keeps people away from stock market in India. Now let me ask you one last question before we move to the next very interesting slides. If I reduce this risk drastically, let's say on a scale of 0 to 100, risk is say 90. I'm just giving you a subjective term. So out of 100 being the highest, 0 to 100, risk in investing in stock market is 90. If I reduce it to 10, again, as I'm just taking some random numbers, you can't really measure risk like that. But if I theoretically take it to 10, do you think some more people will start investing? Type yes in the chat box. Do you think some more people will start investing in stock market if the biggest reason for not investing is reduced drastically? If risk is reduced drastically? Yes, a lot of people are saying yes. All right, so let's do that. In this presentation going forward, we'll look at the steps, the criteria which we take to filter out stocks so that the risk is reduced drastically without compromising on the returns. That's the best part, without compromising on the returns. I already told you the secret number 2, lower the risk, higher the return. And you'll be surprised. It's not higher the risk, higher the return. It's lower the risk, higher the return. Let's look at the first criteria. Dividend paying stocks. So let me try to explain what is dividend. So dividend is something which a company can pay out to its shareholders out of its profits as per their own discretion. So it's not something mandatory by the government. Let's say I'm a company which has made 100 crores of net profit this year. I can choose to take out 20 crore rupees out of that and distribute to all the shareholders in the proportion of the shares they're holding. Now I'll prefer a dividend paying company. Why? Let's say there are two companies, company A and company B, right? Now company A, both of them made, let's say, 500 crores of net profit for this year. Company A says, I will invest this entire money into expansion of the business so that the company can grow. If the company grows, the stock price will go up. Fair enough. Company B says, I'll take out 100 crores out of 500, that is 20% of my net profit, and share it with my shareholders. And I will expand the company with the remaining 400 crores. Now, this is what company B is doing. After 10 years, I notice that company A is not growing as much as company B. Despite the fact that company B is paying dividends, it is growing more than company A. So I'll prefer company B any day, right? Because it is giving me out dividends and still it is growing with that smaller amount of money, it is growing well. So it is more efficient. It is not more fundamentally strong, right? So I'll prefer a dividend paying stock. Now, why am I saying preferably? Because I have a lot of criteria which I'll share with you. If a company is fulfilling all the criteria and it is in a very fast expansion phase, I will relax on this criteria, at least for a few years, if not for very long, right? But I'll still prefer a dividend paying stock any day, right? Now, so some people are saying quite a few companies don't pay dividend. Yes, let me give you the best example. Berkshire Hathaway, the company of Warren Buffett, they have never paid dividends in the last 55 years. But the best part about it, the companies in which they are investing into, 90% of those companies pay dividends. They always take dividend paying companies. So there are two schools of thoughts with respect to dividends. Some experts say I'll prefer dividend. Some say I will not prefer dividend, or some say I'm indifferent. Right. So there is no right answer to that, but this is what I prefer because of the kind of experience I have had with the investments I made. Right. And Warren Buffett has got best of both the things. He invests in companies which pays dividend, but he himself never pays out a dividend. And he explains that in his AGM and all. You can read the annual reports, you'll get to know why he says that. Right. Anyway, let's move forward. Increase in tax paid. Now let's understand one very simple thing. A company can pay out taxes only when they're making net profit. Simple, right? You will not pay taxes if you're making a loss, right? Now, if a company is increasing its taxes paid every year, that means it is making more and more money every year, right? The revenue is increasing, the margins are increasing, probably the net profit is also increasing, right? So if I look at 5 years of block, not every year of business, it's a business, every year they might not do a growth, but in a period of 5 years, if they are growing and they are paying out more taxes, there's a cash outflow, which means there has to be a cash inflow. So this is something which was suggested by Benjamin Graham, who's a guru of Warren Buffett. There's a book called The Intelligent Investor. That book mentions this very, very simple criteria to check. Check the taxes paid by the company in last 5 to 10 years. Is it increasing? And also check the dividends paid by the company in last 10 years. Is it increasing? Because if the cash outflow is increasing, it means cash inflow is increasing. Because these two line items, taxes paid and dividend paid, cannot be manipulated by any company. Because if the audited reports are saying that company has paid a dividend of say 500 crores or paid a tax of say 1000 crores, it means the amount has actually gone out from the company's bank account and to the government in the form of taxes and to the shareholders in the form of dividends. It's an actual cash outflow, right? So I'll prefer dividend paying stocks and where the tax are increasing. Third one, long history of revenue growth and profit growth, again over 5 years plus. Now, very simple to understand, but a lot of people, what the kind of news which was coming right now also in COVID, this company has made some kits for COVID and now it will do very well. If you look at the past record, they were making losses. So I will not go with company which has not performed in the past, even though I might lose the opportunity. Why so? The simple reason, when a company has been performing in the past, it also shows the capability of the management. They're able to grow the company. They have that capability. They have that skill to grow, right? And even if you look at it's a common sense. Let's say you are in a job in a corporate world, you will get promoted when you work in the current profile, right? Though a lot of people say past performance is not a guarantee of future. Absolutely, that's right. But so even the company can say your past performance is not a guarantee of future. I will not promote you ever. They don't do that, right? It's obvious that you will get promoted only when you perform right now. So I will choose a company right now only when they have performed in the past, right? So very simple, look at the revenue growth and profit growth of the company. I prefer to look at for last 10 years, but at least 5 years of data, not last 1 year, not last 2 years, not last 3 years. Even in last 1 year, they have made losses or they have, the profit has gone down. I'm okay with that as far as they are making profit in the long term. All right. Next, zero or low debt. Look at all the companies which have been failing. Look at all the bankruptcy filings which are happening, all the frauds which are happening. It's more often than not happening because of high debt. Be it Jet Airways, be it Kingfisher, be it Reliance Communication, you take any company, 90% of the cases, it is because of high debt. So as per theory, as per management books, if you look at, it says if you take debt, you can make higher returns, which is theoretically right, because when you're taking money from someone else and making money out of that and returning them that small amount of money back with interest, you are definitely making more money. But practically, when you do the business cycle is not one way. When there are headwinds, when you have problems in the business, you end up not paying the taxes, not paying the interest amount, right? So I'll prefer a zero or a low debt company. Someone is asking what about IPOs? So I will not look at IPOs, because if I don't have last 10 years of data, if I have last 10 years of data, if they are providing that on their website, I'll look at that, and if it is good, I'll go for it. But IPO, I don't need to apply for the IPO. I'll buy much more shares. The number of shares in IPO is very limited. So I'll prefer to buy it when it comes in the open market, even if I don't get the allotment in IPO. I preferably don't look at IPO though. I mean, I have not been investing in IPO. All right. Next one, the most important criteria and the most ignored one. You ask yourself, people who said who are investing in stock market, or you ask people who have been investing in stock market in your friend circle or your relatives, ask how many of them did management analysis. Very, very few people. Very few people. The simple reason, they don't know how to do it, number one. Second, even if they know how to do it, it is time consuming. It takes a lot of effort to find out what management is doing, what are they saying. You read those, between the lines in the annual report. It is not easy, but it is possible to do management analysis. Even though a lot of people tell me, a lot of investors tell me, how can you find out what kind of a person the CEO is, the MD is? We can't even know what kind of a person our known people are. Forget about knowing what kind of a person the unknown guy is, right? But yes, there are some data points which can be looked upon. Let's look at that. Number one, retention of senior management. Now, if the senior management is changing every 2-3 years, that's a red flag. Stay away from the company. If the CEO, CFO, CTO of the company is changing every 2-3-4 years, how can they build a long-term vision for the company? How can they grow shareholders' wealth? They cannot. They should be retained for a very, very long. That shows the culture of the company, right? So I'll prefer a company which has very low retention, a very, very high retention of senior management. And how do you find that? Everything I'm talking about in this presentation can be found on the annual report. You go to annual report, it lists down the names of all the senior management with their designation and for how many years they are serving the company. It is mentioned there. It's all freely available. You go to the company's website, download their annual report and look at it. Right? Next, salary growth versus revenue and profit growth. So let's say the salary or the remuneration, again, remuneration of the senior management is mentioned in the annual report. This is mandatory as per the SEBI guidelines. Right, so you can go and find out who is earning how much, who made how much in the last 1 year in their respective companies, right? All those senior people. So if their salary growth of last 10 years is a 15%, every year the salary of the senior people is increasing by 15%, or the senior most people is increasing by 15%, whereas the revenue of the company or the profit growth of the company is increasing only by 5 or 10%. I will stay away from the company because they are not shareholder friendly company. Right. So someone is saying, Mr. Mistry is saying, is stock market a place of big fraud? The kind of analysis we are doing, that will remove companies which are anywhere close to doing a fraud. They cannot. We will be able to filter them out. Just stay with me for this presentation. So salary growth versus revenue growth. You got this. Senior most guy, the chairman or the CEO, on an average for a mid-sized company or a small company, the remuneration should be between 2 to 4% of net profit. Not for large companies. For example, there's a very big blue chip company which has a net profit of say 10,000 crores. Now 10,000 crores cut 2% is 200 crores. So that is not something which is practical. So it will be definitely less than 2%. But for most of the mid-size, that is from remove the first 100 top big stocks and then the remaining stocks in the market. So it should be between 2 to 4%. If it is less than 2%, it's a good sign. If it's more than 4%, it might be a red flag. I have to dig more into it, that if that if that CEO or MD did something really extraordinary to get this kind of a salary. In last 5 years, has he grown the company really manifold to deserve that kind of a salary, right? So that's also one thing which you can check from the net annual report. Next, shareholding and pledging. What is shareholding? Shareholding means the stake you have in the company, the management has in the company. For example, if I am starting my own company and I have one partner, we will have 50% stakes. So as promoters, we have 100% shareholding in the company, right? And what is pledging? I can take my shares to a bank and tell them, you can keep my share. The value of the shares is in the market right now, so and so, which can be seen from the listed company's share price. And I need money on behalf of that. So it's like pledging. You go and pledge your mortgage your house, you go and pledge your jewelry. Similarly, you can go and pledge your shares as well. Now, what is good in this? If the management is buying its own company, shares of its own company, obviously it's good, right? Because that shows the confidence they have in their own company. They know the price of the share will go up in the near future, and they have money as well, right? Nishya is asking red flag. Red flag means I will not stay away from the company. It's a red flag. It's a danger signal, right? So stay away from such companies when I say red flag. So it's a good thing if the management is buying the stocks. Number two, pledging percentage is 0. There's nothing pledged. It's a best thing to have. Next, what is bad about it? If the management is reducing the stake in the company, right? So that's a bad sign. So no matter how much research I do, the management will know the in and out of the company. They know the thick and thin of it. They know what is happening inside. So something bad might come in future in the news. Then we will get to know. But the management knows it beforehand, right? They know what the problem is happening. So that's a sign to look at. And the pledging is increasing. They're pledging their shares more and more to get the money for themselves, for their personal use. Bad sign. What could go ugly? That's the best part. Now, let's say they are not able to pay back to the bank. Now, how to get this data? Again, someone is asking. Everything is available in the annual report. Even in the quarterly reports, there is a data called shareholding pattern. Just type, for example, Infosys Limited shareholding pattern. You will get it for all the quarters you want to last 10 years, 15 years. And it also mentions that that shareholding pattern also mentions the percentage of shares which are pledged. Very easily available. Very easily. Right. So pledging reduced along with reduction in shareholding. When will this happen? So let's say I pledge my shares. I am supposed to pay back to the bank so that I can depledge the shares. I can take my shares back, but I'm not able to do so, unfortunately. And the bank, because I'm not able to pay the interest amount also, bank goes and sell my shares in the market. What will happen? My pledging will become 0 because there's nothing pledged now. Bank has sold the shares, but my shareholding stake, the stake in the company will also go down. That's the ugliest part you can have. So what a lot of people do by mistake is they see their pledging is reduced in last 1 quarter, in last 1 year, and they're like, this is a good sign. No, it's not a good sign. It's a good sign only if the shareholding is also not reduced at the same time. So have a look at this very carefully. If the pledging is reducing, is the shareholding maintained at the same level or is it reducing? Because that is the ugliest thing which can happen, right? Next. This is not done yet, by the way. As I said, management analysis is the most important part of any stock analysis, and we are not done with it yet. Let's move forward. A very interesting one. Remuneration of auditors. Who are auditors? Auditors are CA firm, which goes and audits a company every quarter, every year, right? Again, the remuneration they pay to the auditors, as per the CB guidelines, it is mandatory to mention that in the annual report. So look at the last 10 years of annual report and see the growth in the remunerations. Let's say they were paying 100 rupees to the auditor in 2010, and it is increased to, let's say, 400 rupees now today. So that's like 15% increment in their fees every year, average percentage increase, right? And the revenue is growing by 5% or 10%. It's again a red flag. It means there is something cooking in the company, and the company is stuffing cash in the mouth of the auditors and asking them to shut their mouth. Take your money, shut your mouth. Don't bring this in public. Just write a good report for us, right? Just pass the report which we are asking you to do. A very interesting story. I was listening to one of the analysts who went to a capital goods company in 2008 or 9. This is about 12 years back. Some research, he found out some flaws in the company, and one of the flaws was this auditor's remuneration was increasing much faster than the revenue growth and even the profit growth of the company. He mentioned that to the auditor, to the CFO and the CEO who was sitting there. He said, There is a competitor of yours in the industry, L&T. L&T and you have got the same auditor, same CA firm who is auditing you. L&T is paying 4 crore rupees as remuneration to the auditors, and you being 1/10 the size of L&T, you are paying 13 crores to the auditor. Why so? And look at the growth in the fees; it is much higher than your revenue. Why are you doing so? Plus, he mentioned a lot of other flaws in the annual report because it's such a company will have a lot of other manipulations. The CEO got really angry. He just moved out of the room in a huff. And the CFO is like, before you get this out in the market, can I resign? Imagine. This is the kind of integrity we have in India for a lot of companies. These are the kind of companies which come out with fraud. But if you know these simple parameters to look at, you will be safe. You will be able to safeguard your money, right? So look at this thing very carefully in the annual report. Next, related party transaction. Again, this is a part of the annual report. It shows what other companies promoters are owning, which are not listed. One very common thing is they give out money to these companies in which they themselves are owners. And this is also you can find out from Google, write the name of the company, and from various forums and websites you can find out. And the very common transaction, they give the money to those subsidiary companies at a very low interest rate. 2%, 3%, 4%. Why would they do that? When you can earn 7%, 6% in FD, why will you give out money to a subsidiary company at 2%, 3%? Right? That's a very common kind of transaction. Just look at the related party transaction section of the annual report. Very, very informative. It tells you about the management integrity. Next, capital allocation history. What is capital allocation? Capital means money. So again, Atul is asking where to see management analysis. So all the points I'm talking about, you will find the data for all these points in the annual report. All these points, if you can note down, or you'll by the way get the recording of this session anyway. But make sure you are live, because recording never gets viewed. Very few people end up, you keep on postponing it. Anyway, what is capital allocation? Capital means money, and how are you allocating the money? How are you spending the money? There are two ways to expand your company. One is you open up new manufacturing units, open up new factories, right? The other is you buy out some other company, you acquire some other company. So you look at the past record of the company in terms of kind of companies they've acquired, kind of expansion they've done, and have they made money in that? Again, you can, when you read the annual report, you'll get to know. So if their past record is not good, they acquire a company, they keep making losses, they make new factories, they again are not able to utilize the capacity completely. That's again a bad sign, a red flag, right? Why will I go with a company which is not using the money efficiently? Because if they now come up with some other acquisition, I will be again skeptical. They may lose money in this acquisition. Maybe they are paying much more for the acquisition than the company is worth it. The company which they are buying. Right? So look at that. Earnings call transfer. What is this? So every quarter when the results come, or for some companies every year, the management of the company comes up on a con call with the analysts across the country. So analysts will usually ask them questions for which they could not get the answer in the annual report or the quarterly report. So again, this makes it very, very important. And this is again, you just type on Google earnings call transcripts, Infosys Limited, Reliance, HDFC, whatever, you will get the recording, or you will get the transcript. You can read the question and answer as well. Right? So again, very, very informative, because you're getting to know something which is not even mentioned in the annual report. Right? And the last, sounds very simple. Simply write the name of the management, the top 2-3 people, the owner, the promoter, and write frauds. So and so person frauds, cases, scams, FIR. If you are finding a lot of such cases, things coming up on the Google, again, that would be a red flag. Right? Someone who is used to doing kind of things which attracts a lot of cases against him or her, that person is not a good person to give your money to. Right? So next, we're done with the management analysis. Next one, competitive advantage. Now, what is that? Basically, how well are they placed compared to their competition, right? Let's look at the first one, switching cost. Now, switching cost, just a second. Switching cost, let me give you an example and explain you. Banks are a very good example of switching cost. Now, question to all of you. Whichever bank account you have, be it HDFC, SBI, ICICI, Axis, whatever bank account you have, since how many years are you holding this bank account? 5 years, 10 years, 12 years, just answer give your answer in the chat box. Whichever bank account you have, since how many years are you holding that bank account? 10 years. All right. What else? 12 years, 6 years, 8 years, good. 20 years, all right, great. 4 years, 7, 15, got it. Now let me tell you something. Why do you stick to a bank for a very long term? Because when you have to switch your bank, when you have to close the existing bank and open a new account, there's a lot of activity which you have to do at the back end. Let me give you some examples. Let's say your EMI is linked to the bank. You have to do the process form filling and going to that company to change the EMI pattern. Let's say your mutual fund SIP is linked to the bank. Your debit account is linked to the bank. Your Paytm is linked to the bank. Your Book My Show is linked to the bank. Right? Look at all those apps in your mobile which are linked to your bank account. Right? So documentation as rightly said by Madhumay. Right? So you don't change a bank, and that's called switching cost. So the cost of switching from one product to another product is very, very high. I'll prefer such companies. So I'm looking at competitive advantage, any company which has at least one competitive advantage. I'm not looking at all the 4 which I will list now. Right? So that is called a switching cost. Next, intangible asset. Look at the brand value, look at the patents, look at the IPR of the company, intellectual property rights. So all these are intangible assets, right? When you say Maggi, it is understood Nestle Maggi. Noodles means Maggi, right? Even though if you have the most healthiest noodles from maybe Patanjali, you will still go with Nestle Maggi. Right? So that's a brand. That's an intangible asset, right? So that's also very important. Next, cost advantage. Let's say a steel company which has got coal as its raw material. Coal is a raw material for steel. Now, if a steel company has got its own coal mines, they own a coal mine. That's a cost advantage because they don't have to buy coal from Coal India or maybe other companies, right? So they will be able to source coal at a much cheaper rate compared to their competitors. That's called cost advantage. So look for companies which have got some kind of a cost advantage. Next, network economics. Now, what is network economics? Let me give you a few examples. You are on Facebook because everyone else is on Facebook. You are on WhatsApp because everyone else is on WhatsApp. There are, I'm sure, betting chatting platforms than WhatsApp. They are better social media platforms than Facebook. But you are there because everyone else is there, right? That's called network economics. So look for companies which have got either of the 4, at least one of the competitive advantages. This is again one thing we look at while doing the research. Avoid. Now, what not to do? That's also very important. What all should you avoid? What industry should you avoid? Let's look at that. Technology. Highly unpredictable. Now, if you look at the history of Indian stock market, technology stocks, IT stocks have given one of the best returns. But I am saying I'll stay away from technology. Now, before I move forward, one very important disclaimer. I am not claiming that the companies which are getting filtered out are bad companies. I'm not claiming that. Please take it very seriously and please listen very carefully. I'm not claiming the companies which are getting filtered out are not good companies. No. In fact, at any point in time, there will be at least 100 stocks. By the way, there are 6,000 stocks listed in the Indian stock market. There will be at least 100 stocks which are not in my portfolio and they're giving better returns than my stocks. At any point in time, I find that. Minimum 100 stocks, which is huge, right? But I don't regret that. Why? Because I have to follow a certain process. I have to follow investing in a fundamentally strong stock and I have to reduce my risk. Remember why we are doing this exercise? Because we have to reduce the biggest factor which is stopping people from investing in stock market, that is risk. And as I said, I will prove it to you, it will lower the risk, higher the return. So you don't have to worry about, oh, we are reducing the risk, our returns will also go down. No, it will not. You will make more than 15% returns for sure. Let me show you the examples as well. And we saw in the Excel sheet, 15% is more than enough. Warren Buffett made 20%. He's one of the richest guys. Yeah. So whatever companies I'm filtering out, they are not bad companies. They could be very good companies, but I am okay with, I will not regret. I'm okay with losing out on them. But I'll stick to my filtering process. So technology companies have done very well in the last few years in India, but I'll stay away because they're highly unpredictable. Let's say I'll talk about companies outside India as well. BlackBerry. 2010, I remember it was a matter of pride to have BlackBerry in your hand, right? I remember looking at people having BlackBerry. I used to think that there must be some big shots in their company, right? There must be some very rich people. So that's the kind of image a BlackBerry holder had. Today, where is it? right? Now, let's look at Nokia, same story. They could not reinvent themselves out, no matter how big they were in 2005 and 6 and 7, right? Look at Apple. It was a smaller company compared to Infosys of India in 2001. You'll be surprised to know that. Today it is bigger than a Microsoft, right? So we don't know which company will become rocket and which will become bankrupt. I'm okay with losing the opportunities, right? Now, one more very important thing. Warren Buffett also says I don't invest in technology stock, but he invested in Apple recently. Recently, as in about 5 years, 4 or 5 years back. And a lot of people asked him in the AGM and in the interviews, why did you invest in Apple when you stay away from technology stocks? Listen to what he said. Very interesting. He said Apple is no more a technology stock. It's an FMCG stock. The way you sell, oil and soap, that's the way people buy phones these days, mobiles these days. And iPhone is like a dream for most of the people. Once you get Apple, you will keep on upgrading to in the same phone. If you don't have an iPhone, you will aspire to buy an iPhone once you have money, right? So if you look at what is playing important part in the company, is it the technology or is it the brand of the product? Right. Next, pharma. I will stay away from pharma for these reasons. Cost of research, very high amount of money has to be spent on R&D, and we don't get to know. For people who are asking questions, I might not be able to respond right now. Just keep the questions ready. At the end of the session, we'll have a Q&A, because I don't want to break the flow of the session and it might extend to a very long one. I want to finish it in time. So just keep your questions ready. Maybe take a notepad and pencil or paper, a pen, and you can keep a note of it. I'll answer all the questions. There will be a very detailed Q&A. I'll be available for long, right? So pharma, so R&D, we don't know whether the result will come or not, and when will it come, right? So it's like a black hole. You keep on putting in money, and you don't know when the results will come. That's one reason. Second, even if you develop some new drug, some new medicine, and you don't get the FDA approval, it's of no use, right? Even if you get the FDA approval, but you don't get the patent, the competition comes in. So again, your profit margins are reduced. So I'll stay away. So again, there's a problem. Next, it's usually a very highly regulated company industry. Right? So I stay away from pharma for these 4 reasons. Again, there could be very good pharma companies. A lot of pharma companies in India have given excellent returns. I am okay with losing the opportunity. Right? Why am I okay with losing the opportunity? Look at the history of all the successful investors across the world. Don't you think Warren Buffett would have lost opportunities? Many. Peter Lynch, Philip Fisher, Benjamin Graham, Rakesh Jhunjhunwala, Vijay Kedia, they've all lost many opportunities. Still, they are the richest. We have something to learn from this fact. They have lost a lot of opportunities. Still, they are the richest. Right? So you don't think that I should have the best companies in my portfolio. I should not miss out on anything. Don't have that FOMO, fear of missing out. It's okay to miss out on a lot of companies, a lot of them. You don't need all the best of the best companies in your portfolio. No, you need to make 15 to 18% returns. That's it. You will make that with following a very basic fundamental approach. You need to make money at the end of the day, right? You don't have to lose your sleep in just looking for the best companies out of 6,000, right? Now, commodity. I'll stay away from commodity companies. Let me give you some examples. All the metal companies, fuels, agriculture, and mining products are an example of commodity, right? So if you see in the picture, any company which is producing oil, it's a commodity company. Any company which is in agriculture, it's a commodity company. Any company which is into producing aluminum or steel, copper, all these are metals. These are commodities. So I'll stay away from them. Why? Why will I stay away from them? It's a product. Commodity is a product which cannot be distinguished. What it means is there is no value addition. For example, if I need to get petrol for my car, I will go to HP, BP, Reliance, whichever is on my way. I will not care. I mean, Reliance will not give me petrol 5 rupees per liter less than HP or BP, right? Or they will not give me petrol which is much higher quality than HP or BP, right? So I'm indifferent, right? Sugar I'll buy. I mean, there are definitely different products, and some products must be better, but essentially it's a commodity, right? Steel, it's a commodity. Whether I buy from Tata Steel or SAIL, it's the quality would be almost same, right? So So as Madhuma said, no brand differentiation, right? Next, why is it a problem? Because of this quality of commodity that they cannot differentiate. There's no value addition. Their net profit margins are low. What is net profit margin? Very simple. let's say you sell something worth 100 rupees, the MRP of the product is 100 rupees. And after all the expenses, employee expenses, production cost, and advertisement, and everything, you are left with 5 rupees. After paying taxes, everything, you're left with 5 rupees net profit. So 5 rupees divided by 5 divided by 100 is 5%. That is net profit margin. So usually these companies have a profit margin of below 5%, which is not a very good sign. I will prefer for a company to have at least 7 to 8%, or preferably in the margin in the 2-digit figures. Right? 7% is minimum I look at, preferably 8 or 9% or more. Now let's take a very simple example, as I already shared. Let's say I am a automobile manufacturer and I want to buy steel. Now whether I buy from SAIL or Tata Steel or any other company, it doesn't make a difference as far as I know the quality is same. And I know if Tata Steel is giving me a cheaper price, I will go and buy from them. Right? So the buyer's decision of buying is based on who is giving the lowest price. And that's what reduces the profit margin of the company. Right? So somebody is saying, what about RIL in this case? So let me tell you, now this is not a recommendation. Whatever I talk about any specific company is not a recommendation. It's just for an education point of view. RIL never fulfilled the criteria I had, though they have made a lot of money. They have for the first shareholders in the last 30 years. So it's okay. I'm okay with losing the opportunity. Plus RIL has not qualified a lot of management analysis criteria, which I have, by the way. So I'm okay with losing the opportunity RIL in the next 10 years also, if it's making very good money for the investors. Good if they make money for the investors, good for them, good for the investors, but I am not getting into it. Right? Yes Bank, someone, Shreyans is asking, Yes Bank never qualified for the criteria. You look at the shareholding pattern, you would have never invested in Yes Bank, even for other factors for that matter. Right? So the good part about this analysis is I thankfully am safe for at least from the fraud companies. I mean, I do make losses even after all this research. Out of, let's say, 10 companies, 2 companies will make losses in my portfolio, even after this research. Why? Because it's a business. A new product comes in, a new technology comes in, some new government policy comes in, some new competition comes in. So the company might lose out. So that's not a fraud. That's the reason, which is business oriented. But the point is, I have not lost money because the company in my portfolio did some fraud, right? Because the kind of criteria we have, we thankfully filter out all these companies. Right? Will you invest in Google? So I'm not investing in companies outside India. I believe we have enough opportunities in India to grow really well in next 20-30 years. Google, Apple, and all these companies might make a lot of money for people, but I'm not investing in outside India right now. Again, what further to avoid? Highly regulated industries. Examples: telecom, spectrum. The 2G spectrum, 3G spectrum, 4G spectrum, regulated. Stay away. Power sector is regulated. Pharma sector, I already told you, is regulated. Mining sector is regulated. So all the companies which are in these 4 sectors, I will stay away from them. Again, I'm okay to lose the opportunities, but I will stay away from any company which is highly regulated by the government. Right? Now, why so? For the simple reason that the government has an option to change the regulatory guidelines, change the policies very frequently, right? And that makes it very tough for the company to perform in that kind of an environment. So I'll stay away from such companies. Right? What else? I will also stay away from subsidies. For example, agricultural products. So farming is a very sensitive industry in India. So most of the agricultural equipments and products, or inputs into agriculture, are have subsidy. Now, subsidy is a very good thing if you think about it. The government is paying to the farmer to buy that product, paying a proportion of the cost, which is a very good thing. But it somehow impacts the company in the long run, because government keeps changing its regulations. Right? So I'll stay away from a company which has some kind of a subsidy from the government, because it is kind of a regulation for me. Right? Banking also regulated, you're right, but banking, I'll still stay with banking. See, every industry is regulated in a way because they have to work under the government norms, but it's not as highly regulated as any other company. I mean, if you're following the guidelines of what RBI is saying, banks usually don't have problem. You look at Axis Bank, HDFC Bank, they're doing well. They don't suffer because government came up with some new banking regulation. They're able to go forward with that, right? So it's not that tough there, because government is also very careful about banking regulations. If they change it drastically, it would affect the common man in the near future. Lastly, when I'm ignoring the regulated companies, I'll definitely ignore the government companies as well, the PSUs. The reason is the primary objective of any government company is public service and public utility. Right? It is not stock appreciation. It may happen. SBI might have given very good returns, but that is not the objective of the government. Let me tell you a very simple example. How many of you have heard of Jan Dhan Yojana? Type yes in the chat box if you have heard of Jan Dhan Yojana. Have you heard of Jan Dhan Yojana, which was launched somewhere in 2014-15 financial year? Yes? Yeah. Quite a few people have heard of Jan Dhan Yojana. All right. All right. So Jan Dhan Yojana, they have opened 35 crore bank accounts of the lower middle class people or the bottom of the pyramid people. Right. When they had to open the bank account, the government ordered SBI and all the public sector banks to go in those bastis and all those areas and open the bank accounts. When they went there, they realized there is no, they don't have any address proof, they don't have any PAN card, they don't have any passport size photo. So they did the operation to get all this made first, and then they opened the account. And this entire operation, they had to incur a lot of losses because it was of course expensive, and it involved money to do all these things. When they opened the account, 1/3 of the accounts had zero money. I guess even today a lot of accounts have nil balance, right? And a lot of other accounts had 10 rupees, 100 rupees, 200 rupees, 300 rupees. So that overall, even today, they are making losses in those accounts on a revenue and cost basis. So whatever revenue they may make out of every Jan Dhan Yojana account, they are spending more on those accounts as a per account basis. So though it might be good for the nation that they open 35 crore account, will be good for the financial inclusion and all, but it's not good for the company, right? And they are talking about the entire nation's benefit. They are not supposed to look at the company anyway, right? So it is okay. So, but I'll stay away from such companies. Why? Because it is not good for my investment. Now, lack of efficiency, we all know. I mean, you go to a government department, you know the lack of transparency and lack of accountability. That's another reason for not investing in PSUs. As I already told you in the last slide, government can come up with new policies at any point in time, which is good for the nation, but not good for my investment. And lastly, we all know about the corruption in the government. Most of the time, politicians are involved. All these PNB scam, so most of these, Nirav Modi and Vijay Mallya scams, just take a note. Majority of the money they have taken from public sector banks. So then let's say there are a consortium of 10, 7, 8, 9 banks who have given them total 5,000 crores, 10,000 crores of money. 70, 80, 90% of the money will be from, sometimes 100% of the money is from public sector banks. Because the chairman of the bank gets a call from the politician, he's my guy, just give him the money. I mean, that's I don't have, that's not a secret I'm revealing. That's something very, very, it's known very well, right? So that's why I stay away from government companies. Now, so we're done with all the 9 criteria which I wanted to share with you. A very important question for you. 6,000 companies are listed in the Indian stock market. How many companies do you think fulfills all the 9 criteria? India is a growing economy. We are the youngest country in the world. 65% of the population is below 35 years of age. The entire world is coming here. Facebook is coming here. Uber is here. Walmart is coming here to invest because they know India will grow. In this growing economy, how many companies out of 6,000 do you think fulfills all the 9 criteria which I shared with you? Let me see if I have a poll for this. I think I do. No, I think my internet is a bit slow. Just a second. Okay, I'm getting already quite a few answers from people. Let's see if I have a poll. All right, we have a poll. So I'm launching a poll. Just answer there. How many stocks out of 2,000, out of 6,000 fulfill all the criteria? Is it less than 50? Is it 50 to 200? Is it 200 to 500? Is it above 500? Let's see what most of you think. How many companies do you think fulfill all the 9 criteria which I shared with you, which can pass through this fire, this which can pass through all these tough stringent guidelines which I have created for myself? All right, quite a few people are saying between 50 to 200. Few more seconds, you can answer. You can give your answer. How many companies out of 6,000 listed in the Indian stock market do you think fulfills the criteria? All of them. All right, I'm ending the poll. So 42% people say it is 50 to 200 stocks out of 6,000. About 29% people say less than 50. 17% people say 200 to 500, and about 12% people say above 500. All right. The people who said above 200 or above 500, you'll be a bit surprised because there are around 25 to 30 companies. A lot of you were quite close, or exactly right, maybe. So around 30 companies, you can say out of 6,000, which is 0.5%. Only 30 companies fulfill all the criteria. So it keeps changing. Number of companies keeps changing. It sometimes it's 25, sometimes it's 35. It goes up to 40 also. Sometimes it goes down to 20. But average it is 30 companies out of 6,000 companies which fulfill all the criteria. Now, this is not some formula. I have put up a formula, got 30 companies, and I go and invest in all 30 companies. No. Now the detailed research will start. This was not research. This was filtering out. Right. Let me show you show you what we do now to do the research. Stock criteria, the reports and documents we read through. We read through a draft red herring prospectus. So when someone was talking about IPOs, right? So IPOs, when they launch an IPO, they are supposed to submit a DRHP to the exchange and the SEBI. That DRHP is available as a document which is available in the public domain. You can go and Google and find out. That talks about what all company has done in the past and what are they planning to do in future. Very, very important document. Make sure you read through that. Even if the IPO came 10 years back, go and read the DRHP, right? Next, annual report. I read through at least 10 years, at least 5 years of annual report, preferably 10 years of annual report. Annual report is like an ocean of information when it comes to any company or even for an industry for that matter. Quarterly reports. So for stocks which I am holding, it's very important for me to go through the quarterly reports. I mean, not that I have to change the companies. I don't churn very frequently, but whenever there is a report coming out, it is mandatory for me to go and read it out. Credit rating agencies report. Now, very few people look into this. All these CRISIL, CARE, ICRA, they come out with reports of companies which have taken some debt. Now, I prefer low debt companies. So even in low debt, there is a CRISIL or ICRA or CARE report or maybe Fitch rating report which is coming out. So go and read that report. It has information which is usually not available in the annual report. A very small document, 1 or 2 pages, are very, very, very insightful. Right. Next, industry reports. Look at what is happening in the industry. It's very important for you to keep a track of the different products which are coming in, new technology coming in, new competition coming in. Very important in terms of understanding the entire family of that company. Companies, products, and future technology impact. I already told you. I go through the YouTube videos, go through the articles and reports. A lot of information available on Google freely. Right. Annual reports and credit rating agencies report of biggest 2 competitors. So a lot of times companies will not mention things which they are not good at. Right. For example, Infosys will not mention what they're not good at, but TCS might mention that. Right. So when you read TCS report, you will get to know this is something which Infosys is missing. So take out at least 2 competitors and read their annual reports. You don't have to read 10 years annual report. Just read the latest annual report of the 2 competitors. You will get to know. Right. And of course, the government policy. So the companies are not highly regulated in which I am investing, but there is some government policy around it. Right. Around every industry. Right. So we have to make sure we are aware of what is happening on the government side. Now, after going through all this for all those 30 companies, this is what we are left with. 6 to 9 stocks only out of 6,000. And this is where we put in our money. Right. Now, a question to all of you. We started with the target of reducing the risk. Do you think the risk has reduced drastically? Type yes in the chat box if you think the risk has reduced drastically by applying all these filtering and criteria and research and reading through all this. Yeah, I want to see a few more answers. Yeah, got it. A lot of people believe and feel that the risk has reduced, right? And that was a objective we had, right? Risk has reduced. Some people are saying little bit. Well, that's fine. That's fair enough. The idea was to reduce the risk. It cannot be measured more or less, but it has been reduced. In my experience, it has reduced drastically. I sleep peacefully because I have done this kind of research. Right. Now, let me give you examples. What about the return side? Risk has reduced, right? But what about the return side of that? Have you heard of this company, Supreme Industries? Any idea which industry, what kind of products do they make? Can you type what kind of products do they make? Supreme Industries. All right, I'll give you the answer. Plastics, yes. Vishal said plastics. Furniture. So furniture is just one of the products. They have got more than 5,500 different kinds of products or SKUs, stock keeping units, right? Now, let me give you some examples. The laptop or desktop which you might be sitting on, that plastic part of that desktop or laptop is from Supreme, more likely than not. The pipeline in your building, Supreme. The dashboard of your car, Supreme. The Coca-Cola crates, the cold drink crates, the blue color crates which come for 24 carats, that's again Supreme. You look at the pipelines, which is for this sewage pipeline. This is coming into plastics now, Supreme. You name the furniture, of course, is for Supreme, right? So you name the product, there's a very high chance Supreme is there, right? And they fulfill all the criteria, by the way, right? Now look at their growth. Last 16 years data I have taken. 792 crores revenue has gone up to 5,600, and net profit has gone from 14 crores to 461 crores. Look at the dividends. So let's say they made 14 crore, as the report says, 2002 and 2003, they made 14.2 crore net profit, out of which they gave away 7.01% crores as dividend, which is like 49%. They were left with say 7.2 crore, right? And they made that money as 21 crore next year. I mean, they expanded and they made it that big, right? So that's the kind of, they're giving out dividends every year and they're still making money. They're still generating revenue, still generating net profit, right? So I remember we started investing in this company in 2009. This was somewhere in April 2009. It was at 20 rupees per share. And we invested in this company. We are by the way still invested in this company. Per share price of this company in 2009 when we started was around 22 rupees. It is trading at 1,000 rupees now, right? So 20 rupees has become 1,000 rupees. That is 50 times in 12 years, and they have given dividends of more than 120, 129, 130 rupees till date. So that means if I made an investment of 1 lakh, that has become 50 lakhs today, and on an investment of 1 lakh, I have got 6.5 lakhs of dividends. So 1 lakh has essentially became around 56 lakhs, right? So that's the kind of returns you get when companies are fulfilling the criteria. Let's look at the stock price. So 2009 we started investing. So highest price in that year was 76, lowest was 18.7. That's the fluctuation in that particular year. That's how fluctuating the company's prices are. Last year, 2019, highest price was 1232, lowest was 950. Right now it is 1,000. It went down to around 800, 900 rupees in this COVID situation, right? So what is the worst case scenario for me? I start investing at 76 rupees, which is highest in 2009, and I exit at 950 in 2019. This is the worst which can happen to me. Invest at the highest rate in 2009 and 2019, 11 years later, I exit at the lowest price of that year. And what is the best which can happen to me? 18 rupees I invested and 1232 rupees I exited, right? Now, worst case scenario, right hand side, look at it, 31% compound annual returns, 13 times it has become, and left hand side, best case scenario, 49% compound annual returns. And this is excluding, I have not included the calculation for dividends in this percentage. It is actually more than, the returns are more than this because we have not included dividends, right? Now, please don't take this as a tip. One very big caution I want to give all of you. A lot of people, what they do, I talk about this company, talk all good about this in this particular stock. They'll go tomorrow and buy the stock in the market. Don't do that because that is just half knowledge. Why it's half knowledge? You know it's a good stock, all right. So it is important to enter the stock at the right stock, but it is equally important to exit the stock at the right time, right? So I am holding it for 12 years or 11 years. I might exit after 3 months, right? So one of the biggest reasons people lose money in a market is they are looking for tips. Stop looking for tips. It doesn't help you. Half knowledge is more dangerous than full knowledge, than no knowledge, sorry. It's half knowledge that you get to know it's a good company, but it might not remain a good company after 3 months, 6 months, 1 year, right? And by the way, people have lost money in this company in the last 2 years. It went up to 1480 rupees in Jan 2018. Right now it is 1,000 rupees. But if I sell today, I'll still make huge profits. And it's just one part of my portfolio. It's not my entire portfolio. There's a particular allocation to this company in the portfolio, right? So don't buy on tips. It doesn't help you. It doesn't make you money at all, right? Now, next company, Page Industry. This is what it does. It's a franchisee owner of Jockey. Look at the revenue growth and look at the profit growth and look at their dividends, even better, right? Now, all these, look at the different things, different of this company. Now, the price. We started investing in this company in April or March 2014. The price of the stock was 2,800 rupees per stock, 2,800. We started investing at that point of time, and a lot of investors were like, why are you investing in such an expensive stock? So please note one more important point. The price of the company does not tell you whether the stock is expensive or cheap. No, it's the value behind the stock. A stock which is worth 50 rupees might not be even worth 25 rupees. You're paying double the price. A stock which is worth 3,000 rupees in the market, maybe it is actually worth 4,000 rupees. I'm buying it at discount, right? Swami Mishra is asking the same. It's same. Swami, it's same. The same presentation. You would not find anything different. So you may choose to exit if you want to. Right? So don't look at the price of the company to decide whether it's a cheap stock or cheap company or expensive company. No. So we started buying at 2,800 in April 2014. Sorry, 12. I forgot 12. By November 2014, in next 2.5 years, it went to 9,500. And it stopped fulfilling one of our criteria and we exited. In 2.5 years, we made 3.5 times money. We exited. The stock went up to 36,000 after that, came down to 16,000. Look at someone who bought the stock at 20, 25, 30, 36. It came down to 16,000. Again, it went to 25,000. Right now, it's around 20, 25. I have not checked it in the recent time, but it is a fluctuating company again, right? Now, again, as I said, I would not regret that I should have stayed invested. No, I'm okay because the company I invested in the next, after exiting from this company, I've made much more money, right? So it's important to be disciplined, right? Look at the same fluctuation. 2009, look at the highest price, 3,400, lowest price. 2019, highest price and lowest price. Look at the fluctuation. From all these things, 70,000 right now. Yeah. So it has gone up to a peak of 35, 36,000 this stock. So a lot of people are still in the loss. Right. The worst case scenario returns are 18%, best case scenario 25% compound annually. Not as good as Supreme, but it is pretty good. This is like till date, till 2019. We made much higher returns because we exited in that 2.5 years of time. Right. And I do not own this stock now. Did you notice one thing in both these companies? Stock price was volatile. It was fluctuating, right? We showed the example of, in a particular year, what is the highest price, lowest price, that was fluctuating, right? This is what people call risk, if you think of it. I bought a stock at 100, went down to 60. Stock market is risky. Then it went down to 120. It's good, but this is so fluctuating. It's very risky. I'm scared. I'm afraid. Right? But think about it. Is volatility actually equal to risk? They are two different concepts. Another 3 minutes and we are done. Someone is asking how long it will go. 3 to 4 minutes we are done. So volatility is not equal to risk. Volatility is simply fluctuation in layman terms. Risk is something else. Risk is about losing money. When it went down from 100 to 60, I will buy more. It's an opportunity. This is what Warren Buffett said. Volatility is a long-term investor's best friend. Please note, he's saying long-term investor's best friend, not short-term investors. Short-term investor, volatility will kill you. So provided you have knowledge and patience both at the same time, you will use volatility in your favor. If you don't have any of one of them, volatility will work against you and you will lose money for sure. Right? Now, this is what brings me to the second secret which I shared with you. Higher the knowledge, lower the risk, and higher the return. So risk is a parameter is a function of knowledge. If you have good knowledge in any particular industry or subject, you will feel risk, you will perceive the risk as very low in that. The less the knowledge, the more the risk. So the more knowledge we have, the more research we do, the more knowledge we will gain, the more conviction we will gain, and we will perceive less risk, and we will actually have less risk, and the returns will still be great. right? So it is not higher the risk, higher the return. Higher the risk is equal to higher loss. Simple. Stop asking people, tell me some risky stocks. Why do you want to lose money? Start asking, tell me some low risk stock which can give good returns. If you really want to take some tip, at least take the right tip, ask the right question. No, I don't know how many people will be experts will be able to answer that, but I'm saying at least ask the right question. Don't look for high risk stocks. Reliance Communication was a high risk stock. Kingfisher was a high risk stock. Jet Airways was a high risk stock. Did you get high returns? No. You lost money. Yes Bank also was a high risk stock. You look at the way they were doing the business. You read just one annual report of Yes Bank when it was doing good, when the share price was doing good. You will know you should not invest in that bank. Just one annual report. And look at the criteria I mentioned. You will be like, I will never invest in this company. Right? Now, a lot of people ask me, tell me some multi-bagger stock. What is a multi-bagger? Something which becomes 10, 20, 30, 50, 100 times in 10, 15, 20 years. Right? So you want a stock which can become multiple times in a short period of time, not short period of time, in a span of time. But I always ask them, can you really hold it for that long? Because it will take time to become a multi-bagger. Right? Let me show you some examples. Maruti, 41 times in 16.5 years. Asian Paints, 22 times in 10.75 years. MRF, 126 times in 18.2 years. Please don't just look at number of times, look at number of years. How many of you have stocks for last 10 years, 15 years, 18 years, 16 years? Forget about that. Do you have any stock for last 5 years, which is a well-researched stock, not just any stock? How many of you are holding stocks for that long? Look at Eicher Motors, 420 times in 20 years. Britannia, 50 times in 15.5 years. Pidilite, 31 times in 10.75 years. Let's say you have 10 lakhs rupees invested in Britannia. It becomes 50 times. 10 lakhs multiplied by 50 times is 5 crores. Ask yourself, will you hold on to that stock till it becomes 5 crores from 10 lakhs? 10 will become 12, 15, 18. You will be like, let's exit. We are done. Max 20, 25. You'll be like, we have made good money. What else do we need? You will exit the stock, or people make losses in good companies also. Supreme Industries is a good company, but it fluctuates. In that fluctuation, people lose money. They buy high, they sell low because they don't have patience. And they don't also have knowledge that this company is good, I should stay for long. No. So the only reason you can hold on to a company for long is when you have conviction. The only way you can have conviction is when you have knowledge. Without knowledge, you will not have conviction. Without conviction, you will not hold any company, no matter how good that company is. You will not hold that company for 10, 15, 20 years. And you will not make a multi-bagger. You will keep reading these WhatsApp messages and Facebook posts. This company became 100 times, 50 times, 20 times, and you will keep having this wishful thinking, wish I had this company in my portfolio. Maybe you already have that company in your portfolio. Are you investing enough, first of all? And are you going to hold it for that long? Right? Last slide. Bottom line. You all know this guy, founder of Amazon. He asked a very simple question to Warren Buffett. You are one of the richest guys in the world, and your investment process or thesis is so simple. Why doesn't everyone just copy you? When he says copy you, he's not saying copy the stocks. That doesn't work, by the way. If it was possible to copy the successful investor stocks and become rich, we would have had at least 1 million Warren Buffetts or Rakesh Jhunjhunwala in the world. We don't have that. And why it doesn't happen, that's a different theory altogether. It's a long thing to discuss. I will not take that right now. But the idea is, why do people copy your philosophy, your approach to investment, your investment criteria, your filtering process? Why don't they learn from your mistake? Now, before I tell you what did Warren Buffett answer, tell me your reason in the chat box. Why would you not follow Warren Buffett? Why would you not read about him? What is your reason? What is stopping you from following Warren Buffett? Whatever he has done, he has shared openly with people. In his interviews, in his annual reports, in his letter to shareholder, in his articles, he shares openly with people. Not only Warren Buffett, other successful investors, all open in the market. Lack of knowledge, I get that. Making quick money is one very important. Patience, you don't have patience to read that, right? You don't have patience to learn all that and apply that. It takes effort. Time of entry, exit, you will get to know when you read. When you have knowledge, you will know. Knowledge you don't have, but you can gain knowledge. That's what I'm saying. You can gain knowledge from what Warren Buffett has done. What stops you from taking that knowledge? Lack of concentrated efforts. That's right. Let's see what this guy said. Very interesting point he made. He said, because nobody wants to get rich slow. Right? Someone said lack of patience or quick money making. Yeah, so that's exactly is the problem. Right? Again, a question to all of you. Do you think it was easy for you to understand the criteria I shared with you? A lot of you are engineers. I am an engineer myself. A lot of you are not from a finance background. Don't you think it was simple for you to understand the steps I explained? Was it like rocket science to understand the criteria I was explaining? No, it was very simple, right? It was easy to understand. Say yes in the chat box if you think it was easy to understand whatever I shared with you in terms of criteria, no matter which qualification background you are from or which industry you are from, right? It was easy, right? That brings me to the third secret. Stock market is the easiest way to get rich, but not the quickest. That's the problem. The easiest part, I have told you, the quickest part, Warren Buffett is telling you here. Nobody wants to get rich slow. That is the problem. You may want to make quick money. Stock market is the last place to do that. Yeah, so if it's difficult to implement, it is easy to understand, but difficult to implement. That's right. Because it's a psychology, it's a temperament of the humans. It's a temperament which is important. Right? All right. So that's about it. A couple of things I would like to share before we move on to the next part of the webinar. You can go to the website anupamdunda.com and go to the WhatsApp section of that and subscribe to the WhatsApp broadcast. We share posts regarding investment concepts, insights, and regarding stocks as well on a regular basis. You can also join the group called Learn Stock Investing on Facebook. You can follow us on or connect with us on Twitter and LinkedIn as well. And you can note down my email ID as well if you have something to share. Right. So that's about it. Before we move to the next part of the session, where I'm going to offer you something, the webinar is over right now.